Questions so far? Okay. That's really small. I want to make it bigger. So if you guys watch these videos, okay, I try not to watch these videos if I can help it. If you guys watch these videos, can you see the writing up here? Can you see the lettering? Maybe you don't watch them. I don't know.
Yeah.
I don't see like exactly what it says, but I can see the big stuff, so I can find it in the book.
Okay, so you can follow along in the book. Okay. I just didn't know for those like the online class I post these too, so I can see it. I just didn't know if there's I don't know that there's a better way to do it. Okay, so rental income. The rental income would be any rental income received or accrued for the occupancy of real estate or for the use of personal property. So oftentimes we think of rental as just someplace we're living or occupying or using as an office, but there are a lot of places that also rent equipment and other types of items. You know, think about like if you've ever been to a wedding, a bigger wedding, chances are like all the tables and chairs at that wedding were rented, right? The space that was used was rented. So it would include all of that type of income as well. Now we have to make a distinction between whether or not it's a passive activity or an active activity. It is possible for rental activities to be considered active activities, earned income, and then therefore it is subject to self-employment tax, Social Security, Medicare tax. Most rentals probably aren't, but it is entirely possible. We have this guideline called, where is it here? Material participation. Where is it? I saw it up here. Materially participative. So if the taxpayer is a real estate professional, so oftentimes, if you know anybody who is a realtor or have known anybody that's a realtor, you'll probably know that a lot of times they will also dabble in rental real estate. I mean, why not? They're the first ones to know that something's going on the market and if something is a good deal or not. So they'll snatch it up and they'll make a rental property out of it. If they're a real estate professional and they have rental property, now that rental property is considered active income. So they would have to report that income on a Schedule C, not on a Schedule E, which means it's going to be subject to Social Security and Medicare tax in their case. There are also some even real estate professionals, if they spend over a certain amount of time, and it's got to be quite a bit of time. I can't remember exactly the number of hours. It's a certain number of hours per year. If you spend more than a certain number of hours per year on an activity, it would be considered an active trade or business, and therefore it would go on a Schedule C rather than on the Schedule E. So items related to the real estate rental activity, such as rental income and expenses, will be reported on Schedule E. Rental income is not subject to self-employment tax. Rentals also are allowed the 20% QBI deduction. So it's a pretty good deal. You don't have the self-employment income or the self-employment tax, and you get that QBI deduction. All right, but if they work more than 250 hours in that activity during the year, then they would be considered actively participating. So I guess the number's right here. I didn't know they had it in here. Okay, so that distinction is important. Oh, come on. Here we go. So here we've got Jack is a real estate professional. He owns and operates a bed and breakfast in the North Carolina mountains. He provides significant services to the renters and has no other trade or business. As such, in that case, the activity is treated as a trade or business, not as a rental property. So he would report all of that income on his Schedule C, not on a Schedule E. So now he's got it, because that's his business, that's his active, he's active in it, right? He's working It's an earned income. Farm rental income is listed, we're not gonna go into details on it, it's listed on a separate form, 4835. You do see these a lot in Iowa though, because farmers will rent pieces of property to others to farm. They've got some land and they're not gonna farm it, they rent it out so that another individual then farms it. That goes on the form 4835. So, proceeds from rental real estate, office buildings, rental houses, condominiums, townhouses, and vacation homes would be examples. I showed you where those gross rents are listed on line 3 of that Schedule E. Again, we've got this term of ordinary and necessary, so same concept, ordinary and necessary expenses. So that doesn't change. Reasonableness as well would apply to the expenses for rentals, and they're deducted on the second part of that form. So gross rent is the total rent that's collected from each individual. This would include advance rentals in the year of receipt, regardless of the rental period covered or the method of accounting employed. So it's cash basis, remember? So if I say I rent out a property for a year in August, and I require them to give me 6 months rental income up front in August. Well, August is what? 8, 9, 10, 11, 12, 5 months. So I've got an extra month of income there that's not in this year. Well, because I received it though, in this year, I've got to report all of that income, even though that 6th month isn't gonna occur until next year, right? Also, so advance rental does not include, however, security deposits. So oftentimes, as you're probably familiar, when you rent a property, you have to give them some sort of security deposit so that they've got something to hold on to in case there's damage to the property, or they have to, they gotta pay anything out of pocket for anything that happens. So generally, if this payment, there's a difference. So if the payment is subject to an obligation to repay, it is not included in taxable income. So for example, I rented my property in August. In addition to that 6 months of income, I got 2 months of rent up front. I'm not going to include that because the deal is that if it's a security deposit and they're gonna get it back if everything's okay, then I don't include that in income, and then when the time comes to give it back to them, I also don't include it as an expense, right? Because it's subject to an obligation to repay. I'm not gonna include it in taxable income. So here we got an example. December 12, 2022, Della received $7,000 from Philip to cover 6 months of rent from December 15th to June 15th. The payment includes a $1,000 security deposit. She has to include the $6,000 as rental income, but the $1,000 is not reported as income. So security deposit is separate from prepayment of rent. Okay. Expenses paid by the tenant or services provided by the tenant in lieu of rent are also components of rental income. So what do they mean here? So I have a rental property and my tenant doesn't have the money to pay me that month, but instead of they make a deal with me that instead of paying me, they're gonna make some repairs on the property. Okay, they're gonna fix some things. And the value of that is what the rental income would be. That's considered rental income to me. It's still considered rental income. Now, I also get to deduct the expense of it. So it's kind of in and out on my end, but that is in lieu of rent payments. So if the tenant pays an expense normally paid by the taxpayer must include that payment in rental income. Likewise, if the tenant performs services in exchange. Here's an example as well. Bill is the owner of a house, rents for $900 a month. During the winter, while Bill was on vacation, the furnace failed. tenants of the house had the furnace repaired and paid $300 in repair costs. On the first of the following month, the tenants then reduced the rent payment by $300 because they paid out of pocket that $300. So they paid Bill $600. Bill is required to include the entire $900 in his taxable income, but the $300 he can include as an expense, as a repair expense for rental purposes. Okay? Questions so far? Yeah? Okay. Bill owns a second rental house in need of repairs. He allows a new tenant, a carpenter, to live rent-free for 3 months, $1,800 value. In exchange, the tenant is going to complete the necessary repairs. Bill has to include $1,800 in rental income, but he then gets a deduction for the repairs that were made. Now, this example says, assuming they are not capital improvements, we're going to get to that. The difference between repairs and improvements, because they're treated differently. All right, again, ordinary and necessary expenses, that whole criteria still applies. There's also, so all of the travel and transportation rules that we talked about in chapter 6, those all apply as well. Oftentimes individuals will travel to maybe to make repairs on their rental property, or to go and, like, if they're gonna rent it out, they're gonna drive to show the property. That's all related to the rental, right? And that's a rental expense. So let's see, same rules apply to rental property. Travel costs from a taxpayer's home to a rental property are deductible if the travel is for business purposes. Like I said, so repairs, condominium association meetings. If taxpayer stays overnight, meals are also deductible. So the same travel and transportation rules that we already talked about, that distinction between the overnight stay and the daily. Meals, you've got to be careful though, again, because if there's a vacation component to it, you've got to pull that part out. Okay. Standard mileage rate is the same as the business mileage rate. Okay, so there's no difference there. It's not like the charitable or the medical. Okay. All right, so common expenses, which these are all listed pretty much verbatim on that Schedule E. Okay, let's talk a little bit about capital improvements versus repairs. Okay. Where'd I put it? There it is. This is important. Capital improvements are things that are going to extend the life of the asset, right? And they're going to be depreciated. Remember, we can't use 179 depreciation on rental properties, and we're limited to how much bonus depreciation we can use as well. So we depreciate capital improvements. Repairs, though, we expense. So different types, they just get kind of a list of examples of capital improvements. I can tell you that this can get tricky at times, trying to determine if something is a capital improvement or if it's a repair, right? So, like, for example, if the roof is damaged in a hailstorm and you have to replace it, but you replace it with a really nice roof, like one that was way better than the other one that's going to increase the value of your property, and you put up gutter guards and all that stuff. Now you're kind of getting into, well, that's sort of more of a capital improvement. Yes, there's a repair aspect to it, but it's also extending the life of the property and improving its value as well. So I just use that as an example that there can be nuances to it, and it can sometimes be difficult to distinguish. Some of them are pretty cut and dry, But, so additions, if you add on a bedroom, that's capital improvement. Bathroom, capital improvement. Deck, all of these things. Now, heating and air conditioning, if you add a new heating system, that's capital improvement. Air conditioning, anything attached to the house, part of the components of the house as well. Also, outdoor components of a house. So driveway, walkway, fence, wall, swimming pool, all of that stuff. Insulation, roof, plumbing, all of that stuff that is part of the house. General repairs and maintenance are 100% deductible. However, taxpayer cannot deduct amounts that are capital improvements. So allowable repairs are expenditures that neither materially add to the value of the property nor appreciably prolong the property's life. So does it add to the value of the property? Does it lengthen the life of the property? If it does, then it's probably a capital improvement. If it doesn't, then it's probably a repair, and therefore you can expense it. So any repairs as part of an extensive remodeling or restoration are considered to be capital improvements as well. So even if there would ordinarily be considered repairs. So my example of the roof would probably be a capital improvement. Yeah, it's a repair that had to be made, but it was part of improving the, increasing the life of the property and improving the value of it. Let's see. So capital improvements as well require depreciation over the life of the property. 27 and a half years. So that roof, that roof is not gonna last 27 and a half years. How many furnaces last 27 and a half years? 0, right? They still have to be depreciated over 27 and a half years because they're considered to be capital improvements. Now, if you just repair the furnace that's already there, that's different. That's an expenditure. You can expense that 100% immediately. Let's see, what else do I want to say? Oh, yeah, so, and it, 39 years if it's a non-residential property. So certain small rentals, though, can elect to deduct certain improvements as expenses. There's a maximum amount, though. And small, this is their definition of small, 10 million. So that would be most people, right? Taxpayers with average rental receipts over 10 million and properties with a basis greater than $1 million are not eligible. So this would might put people out of commission, the $1 million basis, especially if you've got multiple properties, right? But if you fall under those limits, then you can deduct capital improvements up to 2% of the building's unadjusted basis, original basis, or $10,000, whichever is less. Okay, so maximum of $10,000. Let's look at this example. We've got Brian is in Birmingham, Alabama, owns a rental condominium in Destin, Florida. Have you ever been to Destin? Destin's nice. White sandy beaches. It's been a long time since I've been there, but it's a nice place. Twice a year. Oh, and they might say travel is prior to July 1st. Okay, so remember the mileage rate changed. He drives to Destin to perform general maintenance on the condominium. The round trip mileage from Birmingham to Destin is 602 miles. So in this case, he gets to deduct $704 in travel costs, 602 miles, 2 trips at 58.5 cents a mile. If he did those in the second half of the year, it would be, 62 and a half or whatever that rate was. Let's see. Questions? It's a little, this topic's a little bit more relatable, probably. You can visualize it better. Yeah. All right. So we depreciate the rental property. Some aspects specifically related to, I don't need to read that. So for the rental structure, the depreciable life is 27 and a half years. This is where we start to kind of get into some allocation issues. So the structure itself is 27 and a half years. Remember, most property is not just a structure, unless it's a condominium. Most property also includes some land, right? And we don't depreciate land. We only depreciate buildings. So we have to pull out the value of the land from the value of the structure. Straight line on the structure, 179 is not allowed. You can take 100% bonus for any property with a less than 20-year life. Now, obviously, the building itself doesn't meet that criteria because it's at least 27 and a half years. But we can have components within that building that do meet that requirement. So, because, you know, if we've got a rental property, we probably also have a stove in that rental property. Let's say it's a residential rental. A stove in that rental property. We probably have a refrigerator. Maybe we have a washer and dryer. Those types of things, those appliances. Those would not be considered components of the building. Those are separate. Those are 7-year property because they're pieces of equipment. So we can pull the value of those pieces of property out, and now we can give those to the special bonus depreciation treatment. And we can get a greater deduction up front from this if we want to do that. So and if we have a furnished property as well, maybe we provide the furnishings. So we can pull the value of those furnishings out and capitalize them separately. Depreciation, if it's done in a lump sum though, you calculate that depreciation over 27 and a half years. However, let's do an example here. I'm sure they've got an example too, but we'll do another example. Let's say we bought a residential rental. And we paid $200,000 for the whole thing. We looked at the property tax statement and it told us that 30% of the value of the property is actually attributable to land. If you look at property tax statement, they're all available online. By the way, you can access that, everybody's property tax information online. So 30% is land. So of that 200,000, we're gonna pull out 30% for land, but we also have some furniture that is part of that purchase price, and the furniture was $10,000. And we also have some appliances that were $5,000. So 30% of the land, now we've got to divide the building, I'm gonna put the building here separately. So the building portion of that is going to be, so this is 60,000 for the land and 140,000 for the building. So the items that we can depreciate are the building, furniture, and the appliances. Oh, actually, I didn't subtract, okay, so wait a minute. The full price was 200,000. I've got to subtract these two out of the, well, I'll just make it easier and increase this. So increase this by 15,000. Okay. The land is 60,000. Don't pay any attention to my percentage now because now it's off. But we can depreciate the building, we can depreciate the furniture, and we can depreciate the appliances. Now, if we depreciated them all together, it would be 140, 155 over 27 and a half years, right? If we did all of those together. However, what we can do instead is we can depreciate the building over 27 and a half years, so 140 times 27 and a half, or divided by 27 and a half. 10,000. Well, now we can take bonus depreciation on that because it's less than 20 years. right? But if we didn't take bonus depreciation, it would be over 7 years. And the appliances, 7 years as well for equipment. So if we did the math on this, we would get a greater depreciation deduction by pulling those separate components out and valuing them separately. Even though the building, it means that the building is gonna be a lower price when we actually, like instead of the 155 for the building, now it's 140. But because it's over such a longer period of time, it's gonna have a much smaller effect on the overall depreciation deduction. So I think they've got an example down here. Oh, furniture, actually, that's 5 years, that's right. Furniture for a rental is 5 years. And the appliances, I think, are 5 as well, yeah. It's a little bit different because they kind of take more of a beating when it's a rental. So here's an example of that. We've got Alan and Sherry Masters. They purchased a furnished beach house in San Clemente, California for $1,364,000, June 1st, 2022. Land was valued at $700,000. Furniture, 15. Appliances, 300. Carpet, so they pulled the carpet out too. Well, they didn't pull the carpet out. They pulled the value of the carpet out of the greater value. 4,000. Landscaping, $8,000. They rent the house full time. There's no personal use. If they depreciated the house as a single lump sum, it would be $664,000. We get that by taking the full value minus the land. Okay, $664,000 in the first year. It's a partial year, so, and we'd be using the mid-month convention because it's real estate. 1.97%. They get a $13,081 depreciation deduction. If, however, they go the more, wow, that's kind of messed up formatting. If they go the more complex route, but it's gonna get them a bigger deduction. So the house, now it's $634,000 because what we've done is we've pulled $30,000 of value out of that $664, and we've allocated that to furniture, appliances, carpet, and landscaping. Over these years, and this is just if we depreciate it. We don't take any bonus depreciation on any of those items. So 20%, so 3,000, so their total depreciation deduction is $17,290 in this scenario. They get an additional $4,209 deduction if they're in the 25% tax bracket. They're saving a little over $1,000 in taxes by doing that, right? Not a small amount of money. This is in the first year, and again, as they say here, it assumes that they're not electing the 100% bonus depreciation, which would make the difference even larger. Now, the downside to that bonus depreciation is they would be taking all of the depreciation on this. The only thing they'd have left next year is the $12,490 or whatever the depreciation deduction is for the house in the next year. Make sense? Okay. Where am I gonna do this? Whoops. So we looked at this, what it looks like. So this is, it looks like it's this example. We can I'll show you where all of this kind of fits in then on that Schedule E here. Once I've got it up. Okay, so they're renting it for 12 weeks at $3,500 per week. So they got $42,000 for this. They started renting it, what, June or whenever they started renting it. They paid a management company 10% of their, and usually it is based on whatever the rental income is, a percentage of that. 10% is about average, probably $4,200 for that management company fee. Travel, $522. Repairs, mortgage interest that they paid, property taxes, those are pretty low property tax. Well, of course, they only owned it for part of the year. Property taxes, insurance, utilities, and then the depreciation that we took. So, this is how it all looks. So even though they had they say 365 days, but it was only part of the year, so I think they may have messed up on that. But they had no personal use days. We're gonna talk about what happens when we've got personal use days, okay? So there's their rent and then all of their individual deductions. So their total net rental income, $8,588, none of which would be subject to self-employment tax. It's gonna be taxed at whatever their marginal tax bracket is. Again, the depreciation, so let's look at this again, since we kind of know now what these items are. So we had 22,000 that we pulled out of 5-year property, 8,000, this was the landscaping, of 15-year property. And then the rental property, the building itself, 634,000, and the depreciation for that portion. So there's our depreciation calculation. Let's see, anything else I wanna say here? They talk about the passive activity losses. Are complex, yes they are. So, but we don't do chapter 13. Okay. Questions?